This is Simply Lovaii, and you're listening to the expert with a heart.
Powered by Timber Media.
Welcome back to Simply Lovaii. Happy to have you here on the podcast series. And you know, in today's day and age, I think hustle culture, that's what every young person is out and about doing. We've talked about startups being like the next big thing that everyone wants to do. Everyone wants to have their own business. Everyone wants to chase exciting opportunities, as they should, right? And sometimes those opportunities mean you sitting in India or in one country earning money from another country, and then is when the complications arise, right? How do you really deal with multiple streams of income in multiple currencies? I'm sure it's a topic of conversation you've not necessarily thought about, but when you're in that situation, I'm also sure that this conversation is going to help you manage it. So we've got with us Lovaii, our expert with a heart, and also CEO and MD of International Money Matters Private Limited. But after all these podcasts, I'm thinking that's like your side job now. Your main job is being the expert with a heart. Welcome. How are you doing?
Thank you. As long as I get salary for the side job, it's fine.
Okay, never mind. Let's switch back. And we've also got with us today Anupama Agarwal, who's the Senior Vice President Advisory, Mumbai, Delhi NCR and Far East Asia Pacific. Thank you so much for being here with us. Really excited to dive into this topic because, you know, like I said, it's applicable to so many different people, right? You've got people who may be startup founders, freelancers. So no matter what job type you're in, this is something that could apply to you at some point. So what, in your opinion, Anupama, are the biggest financial planning challenges for individuals, not just with multiple streams of income, but also assets, right? Spread across the globe.
So Ahalya, very, very normal that as soon as you start earning income outside or you're moving countries, you start building assets also outside geographies or across geographies. And the biggest challenges that I see is one, taxation and reporting.
Right.
So depending on the jurisdiction where your assets are, and in India, if you're an Indian resident. And the second bit being investments. So typically, more often than not, because you're away from that geography, you keep forgetting that you have assets there and you need to manage them and manage them wise.
No, that's so I think one of the biggest challenges is just thinking about it ahead of time, which we often come across as a problem in financial planning. But how should one manage, I guess, currency? Okay, so this is important, especially in today's context. The market is, you know, volatile. You look at currency rates and foreign exchange, everything's like shifting, right, on the dime. So how exactly should you manage your expectations, but also the actual money in a situation like that? What are the considerations that you have to make to protect yourself to the furthest possible extent?
When it comes to currency risk, okay, my simple formula or advice is that depending on which currency you need funds in for your expenses, for your running expenses, or for your financial objectives, try and build assets or wealth in that currency itself. Because as soon as you start looking at the currency fluctuations and converting, you are looking at, of course, the rates, and you're looking at the transaction charges every time. So it's a little short term, but if you need to move the currency, then look at it in respect of, okay, what is happening in the markets? Where does the currency stand? And should I move it now, or should I wait for another 15 days or 30 days? That should be the perspective. But if you're looking at long term, then keep it in the currency that you need the funds in.
Yeah, so I think on currency, what happens is for Indians, we have to know that everything is pegged versus the dollar. So the dollar rupee is the most important piece that you have to look at on one side. And that we should understand is that as long as there is a differential in interest rates and in inflation between the two countries, and as long as Indian inflation and interest rate is higher than that of the US, the rupee will depreciate to that extent. So today, the US interest rates for 10 years are about 4.4%. The Indian 10-year government security is 6.37 or almost 6.4%. So 2% per annum should logically be the depreciation of the rupee versus the dollar. So if it is 85 rupees today, it should be 86 rupees and 70 paisa 1 year from today. However, it doesn't work like fixed deposit. It's not a straight line. And we've seen many occasions in the past where these movements are lumpy. If you look at them in the long run, so if you take a 5, 10 year, 20 year time horizon, if earlier the differential in interest rates were 3 to 4%, the depreciation is 3 to 4%. You will find correlation with that. It's just that it happens, like I said, in spurts. So you have to be a bit careful about the movement of currency, to the point that Anupama mentioned, that if my goal is coming up in the next 6 months in dollar, but I have my asset in rupee, then I'd say I came to know about it today. I should try and move the money today, tomorrow, day after, and not later than that in that currency. So at least I know I needed $100 after 6 months. Here I have moved $98. It will earn $2 and $100 is assured on the due date when I need that money. So I think those are things that, I mean, for basics, for starters, I think that's what you need to look at. And then if you're dealing with another currency, then it becomes another ball game of trying to understand what is the cross rates between the pound and the dollar, if I'm thinking in pound, and is that pound to dollar strengthening or weakening, and then I have to apply the rupee dollar and then multiply and get it. So it's two calculations instead of one. Starts getting complicated.
I don't like.
Use a calculator or a financial advisor.
Or a financial advisor. Okay, so you're not astrologers, but you can double up.
Oh
with
yes, of
calculators.
course. Glad you remembered.
Okay, fantastic. So let's move into tax implications, because when you're talking about multiple geographies, this is the one thing that is always applicable. So what are some of the most critical tax implications that Indian residents earning in multiple currencies should keep at the top of their mind?
So foremost, Alia, and people tend to forget that everything that you earn outside India, if you're a resident Indian, has to be filed for taxes, has to be reported. So whether it is foreign assets that you own, including a bank account, whether it is any income that you earned in foreign currency, you will have to pay taxes in India. Okay. Now, all depends on if you've already paid taxes in that jurisdiction, then yes, you can take tax credit in India against those taxes paid, and therefore you can reduce your tax liability in India. But you have to do the tax filing.
I think people tend to mix up that if I am living in India and I earned money in Europe and I deposited in an account in Europe, I don't need to show it in India. That's a problem. It's also the problem the other way around, that people who are outside say, okay, anyway, the government and the bank has deducted taxes, I don't need to file returns. And some of them, our clients, when we sort of push them to file the returns, are surprised they actually get back refunds, because taxes are deducted uniformly, but their income may not be as high as the amount of tax that they've paid.
Surprised?
I hope so. So I think also that you have to recognize that certain countries tax based on residency, that is number of days that you have spent. Some countries tax based on citizenship. So irrespective of whether you've spent days or not, if you're a citizen of that country, you have to file taxes there. So I think being aware about the tax rules and keep being updated with the tax rules become very crucial, because each country like India has budgets and finance ministers, and they like to tinker around things, right? So there'll be amendments, and you'll think that's the rule I read in 2023, but it's not valid in 2024.
It's not. Absolutely not. So you said something interesting before, which is always consider, what is beneficial about keeping an asset or your income in a particular currency based on your own personal goals, right? But just generally speaking, what are the pros of maybe having, should someone intentionally move assets to other geographies or countries? Not the super rich, the other normal people.
I think it is important to know, and as financial planners, if you have financial objectives which are in different currencies, right? So I could plan to send my kids outside India for education. I know that possibly I'm going to be needing funds in USD. then I might as well start intentionally planning to start building assets in that currency, right? What it helps is that when I need the money, I am avoiding any currency risk because I've already built assets in that currency.
Right.
Similarly, if I'm a non-resident Indian and I'm planning to come back to India and retire, then for them to build assets in India makes a lot of sense in INR. So that again, the currency risk is not there. Right, because I'm not talking about a stronger currency, but they could be from any other jurisdiction which has a weaker currency or any underdeveloping nation, and therefore they need to have. Based on where the money is needed, will be assets there.
And I think the message to individuals and even young people is that we all tend to have a very, very strong home bias. And we think, oh, India is the great developing nation and therefore all money should be in India. And sometimes it extends to, I understand real estate very well, so I will only do that, or I understand stocks very well, so I'll only do that, and, take a lot of risk. But I think as financial planners, we need to go, multiple levels higher than just debt and equity allocation or financial versus physical assets. I think before that comes how have I distributed the assets in different currencies and how have I distributed the assets in different countries. Because let's say there is a situation at the border in India, all asset values will drop during that time. It doesn't matter whether it's equity, it is fixed income, it is gold, whatever I am holding, and the currency will weaken because, there is a risk of all assets falling in value. So therefore I need to hedge, and we typically would recommend that as long as your short and medium term goals are in the currency that you require them in, for the rest of the goals it may be a good idea to diversify and have assets outside the country any case.
Yeah, no, fair enough. But also, how do you plan for these things? And I think this is a question that comes up when we think about cross-border financial planning also, because so many times situations in life change and your financial goals are also always evolving, right? So how do you effectively plan for goals that you may have in different geographies, in different currencies? How does one lay down the plan for themselves to do that?
I think simply you look at a situation where you're deciding that you're going to leave from here and travel to a particular place within the city. So what do? You go up and look at Google Map and say, this is the best route. I start on that way. And along the way, there comes, there is a traffic jam and here is an alternate route which will save you so much. I think planning is pretty much like that. So trying to say, I'm going to have everything perfect and in place before I start doing things is a problem. It's as long as you have a trusted advisor at the other side who's able to review this periodically with you, you're fine. Get started. My intention is to go towards south. Okay, I managed and now I've decided I'll go southwest. It is unlikely I will say, no, now I'm going north. But if you do, okay, fine, let's change course and go the other way.
Okay, all right. So what kind of, in this scenario, right, again, cross-border, multiple geographies, multiple jurisdictions, what kind of advisors do you feel are best suited? I already know the answer to this question, by the way. But what kind of advisors do you think are best suited to help clients who have these kind of aspirations or goals?
So very, very important, somebody who has exposure or understanding of the regulations and the taxations, implications, investment opportunities, mortalities of financial products, banking. May not be hands-on, but at least got associates or experience through other clients. I think that matters a lot. Because then looking at the overall or holistic picture to guide you and set it out for you in your financial plan is something that advisor can do.
I don't think we can know everything about all countries. The nuances, the taxation, being up to date with what issues people are facing. So it's very important to collaborate. And as long as you have somebody who has the ability to collaborate with professionals, and therefore I'm using the term professionals and not just tax. So it could be an advisor, tax, an attorney, a divorce lawyer, a trust specialist, it could be any of these. As long as I'm able to get the right sort of help to solve your problem, because you are now dealing with multiple currencies, I think that's the person you need to work with.
No, but it is extremely important to have that network at hand, right? At the very least. So bringing the conversation back to mitigating or managing currency risk in the best way possible. Sometimes you do have things like loans that you're paying off, EMIs, college fees, maybe student loans in a country that you were studying in. How in those situations where those monthly payments are ongoing, do you mitigate or manage currency risk if you've, say, moved out or are in a different geography?
I think the best solution is to move lump sums and keep them as lump sums and make sure that you have bank accounts there and make those payments. Because as we discussed earlier, doing the tactical or looking at the currency fluctuation on an ongoing basis becomes very difficult.
Yes.
So especially when you have liabilities, it's better that you have the money parked there in that currency or taken. When you know that payment is coming up, then move the money immediately as the earliest you can, or tactically, look at the 15 days or the 1 month or 2 months, depending on when that liability is coming up, and move that money at the earliest you can.
So simple thing is, let's say I have $12,000 to pay in the year.
Right.
I can decide that, right now I have $2,000 there, I have to move $10,000. Maybe I split it and say 5,000 now, 3,000 at some point and 2,000 at some levels of currency if I'm thinking that it may be better, or time, and say this is every 20 days or every month I move this amount and I'm done in 3 months time, I'm fully done. And then I don't have to worry about this.
Okay, so taking that a step further, now if you've got international earnings, you've got international assets, we've already talked about in multiple episodes prior, right, about some of the legal and regulatory issues that can come up, and catch you by surprise. So it's always important, again, to consider those. But I'd like to touch upon specifically documentation, right, both personal and also, is it important, what are the kind of documents that one has to constantly keep handy? What are the regulatory, let's talk about that also, considerations that they need to take, or even legal, right? There's a network, IMMPL has a network of legal professionals all over the world to help with certain cases, but why do they need to even be there?
So in terms of documentation, I think the most important is keeping all the banking records,
Right.
or all the investment proofs, and if there is any proceeds which of any income that you've earned. So proof about the initial investment and what it has come out to be, or what is the value at the end of the financial year, those records need to be there. The reason being that you would need to do possibly tax filing in that country, and you will have to do tax filing in India as well. And Indian tax filing needs those documentation.
Okay.
Now, if you've done the tax filing there and you need the tax credit to show here, then again you need to have all the tax related files available to show to your CA here.
Okay.
I think the important thing for people who are moving across countries is probably having a Excel file or a record of the day they left the country when they came back.
Okay.
Because you need to go back many years sometimes to find out whether are you liable for global taxes this financial year or only income earned in India, and so on and so forth. So all those dates become important, and now we see many countries do not stamp the passport. So I think updating it regularly. So India stamps in and out, so at least there is some record. But I think it's important to keep track. Of course, if you are traveling many countries, when you apply for visas as well, they ask you for, give me last 10 years records of where you've been.
Yes,
So
yeah.
this helps in that as well.
Maybe don't go to those countries. I'm just kidding. Fantastic. No, but I think there's a lot of different considerations. You know, you really have to be on the ball when you're talking about not just one geography. But I say this all the time, but financial planning in one country is hard enough. So imagine if you're going to, you know, throw all of these other countries and geographies, rules, regulations into the mix. It's important to start having these conversations early, like the first pound or US dollar that you're earning while you're in India. Start thinking about, you know, how what the best way to manage all of that money is. And yeah, these tips and tricks will surely help. So thank you, Lovaii and Anupama, for joining us today.
Thank you.
Thank you so much.
That was an episode of the Simply Lovaii podcast series. Expert with a Heart.
Powered by Timber Media.